The International Monetary Fund upgraded the United Kingdom's growth forecast on Monday, lifting its 2026 GDP projection from 0.8% to 1%, and publishing what amounted to a formal endorsement of Chancellor Rachel Reeves' fiscal strategy. That endorsement landed in the same week that UK gilt yields hit their highest level in 28 years. The IMFs praised the plan, the bond market rejected it. Both things happened simultaneously, and the gap between them is the question this session cannot answer without assistance. The session itself reflected the tension. The IMF's statement that Britain's medium-term approach continues to strike a good balance between deficit reduction and growth-friendly spending gave Reeves an immediate platform to declare that the choices I have made as Chancellor mean our economy is in a stronger position. Inflation is still projected to rise to just below 4% by the end of 2026. Interest rates are expected to hold at 3.75% for the remainder of the year. Those two figures together describe an economy whose near-term path is worsening, even as the institutional forecast improves. The Financial Times and The Independent both noted that the growth upgrade itself remains well below the 1.3% the IMF was forecasting in January, before the Middle East conflict escalated. The IMF's own phrasing acknowledged the downgrade trail. The war in the Middle East is dampening near-term prospects. That phrase sits awkwardly next to the formal endorsement of Reeves' strategy, because the strategy is being asked to hold together in conditions the IMF itself identifies as the primary risk to its own forecast. What the context layer cannot explain is why the bond market has already moved to price in something the IMF insists is manageable.
UK borrowing costs reached a 28-year high last week, and the catalyst was not the Iran war, not energy prices, and not the IMF's own warning about inflation. It was Andy Burnham. The Greater Manchester Mayor's declaration that he would seek to return to Parliament, clearing the path for a Labour leadership challenge against Sir Keir Starmer, triggered a reassessment in the gilt market of who controls UK fiscal policy in 12 months' time. That is a domestic political risk, operating entirely independently of the macroeconomic framework the IMF was evaluating. The mechanism runs as follows. A new Labour leader, Burnham has publicly stated he would change Labour and decline to commit to Reeves' fiscal rules, could increase spending and government borrowing above the current deficit reduction path. Gilt investors are not waiting for that outcome. They are pricing the probability distribution of it. The 28-year high in yields is not a verdict on the current government strategy. It is a forward premium on leadership uncertainty, and the IMF's endorsement, by design, evaluated the existing strategy rather than its political durability. The IMF was not silent on this. Its report included a passage that was widely read as a thinly veiled intervention in the internal labor dispute. Staying the course on deficit reduction will be important given market pressures and elevated implementation risks. It added that proactively developing contingency measures would help protect fiscal credibility. Translated from institutional language, the plan is sound, but the plan requires someone committed to it to remain in office. The IMF cannot guarantee that variable, and the gilt market knows it. That is where the endorsement breaks down as a stabilizing signal. Reeves used the IMF report to argue against Labour colleagues pushing for a leadership change. Putting our stability at risk when signs of progress are emerging would leave families and businesses worse off. That framing confirms that the primary threat to the fiscal framework is internal, not external. The IMF endorsed the policy. It cannot endorse the government's survival. The condition under which the gilt premium reverses is not an improved growth forecast. It is a resolution of the Labour leadership question. Either Burnham's challenge collapses or a credible fiscal commitment from any successor candidate emerges. Neither has happened. The by-election in Makerfield, where Burnham is seeking to re-enter Parliament, has not yet been called. Until that outcome is known, the 28-year high in yields exist alongside the IMF upgrade as two readings of the same moment that point in opposite directions.
The unresolved question from the mechanism above is whether the gilt premium is temporary, a pricing of uncertainty that resolves once the by-election concludes, or whether it reflects a structural repricing of UK political risk that persists regardless of who leads Labour. The historical comparison that bears weight here is not the Truss mini-budget of September 2022, though that episode is frequently cited. The Truss moment was a policy shock, an announced fiscal expansion that the bond market repriced immediately and in response to a specific document. The current gilt move is a probability shock. No policy has changed, no fiscal announcement has been made, but the market is pricing the chance that one will. That distinction matters because probability shocks are slower to resolve. They require not a policy reversal, but the elimination of the scenario being priced. The trust shock cleared in weeks because the policy itself was withdrawn. A leadership change scenario clears only when the leadership question is settled. The IMF's inflation forecast adds the second variable. At just below 4% by end 2026, inflation is expected to run nearly double the 2% target for the better part of 18 months. The Bank of England is currently held at 3.75%, and the IMF does not forecast a rate hike. A subset of economists disagrees. They expect the bank to act to contain the second-round effects of energy prices. If they are right and the bank raises rates before inflation peaks, gilt yields face pressure from two directions simultaneously: the political risk premium and a higher policy rate path. That combination would stress the good balance the IMF described, in ways the upgrade does not currently account for. The leaning is that the yield premium persists through the by-election, with a modest drift lower if Burnham's path back to Parliament proves harder than anticipated. Reform's presence in the constituency and Conservative debate over standing aside for them introduces genuine uncertainty about whether Burnham wins. A narrower Burnham victory, or a delayed return, would reduce the probability of a near-term leadership challenge and allow some of the political premium to unwind. The verification benchmark to watch is the Makerfield by-election date and the margin. A Burnham majority below 5,000 from the prior Labour result would be a signal that the challenge is politically weakened. The recovery scenario requires that margin to narrow, or for a credible fiscal commitment from Burnham himself. The continuation scenario requires neither. If Starmer's position erodes further within the parliamentary party, Labour Civil War coverage has intensified. With the Evening Standard reporting Starmer will not set a timetable to step down, the yield premium may extend beyond any single by-election result. The IMF endorsed a strategy. What the bond market is pricing is whether the person implementing it will still be in office when the next fiscal review arrives. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.